Hi everyone, and welcome to the Buffett and Beyond Stock Selection Strategy, and it's based on the book Buffett and Beyond by Dr. Joseph Belmonte. And remember folks, if you want to live on the beach like Jimmy Buffett, you really have to learn how to invest like Warren Buffett. And Buffett and Beyond proudly presents to you the good, the bad, and the ugly. And remember folks, the good stock should be in our portfolio, the bad stock should be in somebody else's portfolio, and the ugly stocks should be in nobody's portfolio. And here we are at Stock Analysis of the Week, and we're going over Adobe Systems, and that's because so many of you are asking about this stock, mainly because they have beaten projections every quarter this year. All right, let's go over it. Adobe develops various computer software products that enable users to create, transfer, and print electronic documents. In fiscal 2017, the company operated in the following business segments: digital media solutions, digital marketing solutions, and print and publishing. Now, the leading software products include Illustrator, Photoshop, InDesign, and Acrobat. And folks, all those PDF files that you get and that you send and that you create, that's Acrobat. So we're all using this company's products. And research and development is about 17% of 2017 revenues, has almost 18,000 employees. And let us look at the numbers. And folks, you know we use a methodology called clean surplus return on equity. And it's not the traditional accounting return on equity. It's configured in a different way. And if you want more information on this, please go to our website, or better yet, get the book. You can get it on Amazon, not a problem. But the clean surplus return on equity has been going up, and the market likes that. That means when we see a clean surplus return on equity that is rising, it means that the earnings are increasing each year at an increasing rate. That's like a car going down the racetrack, but accelerating as it goes along. So it's going faster and faster and faster. And that's because the net income and the earnings have been increasing and beating projections. And that's what's so important about this company, is because the return on equity is going up, and it has been since 2013. The market loves that, and that means that the profits that it's making have been increasing at an increasing rate. Now, the other thing that we like to look at is the revenue growth, and the revenue growth projected for 2019, folks, this is going to blow you away, 36%, and that translates into earnings growth of over 14%. The earnings growth over the past 5 years has averaged 65%. Folks, that is just absolutely phenomenal. So this company is averaging revenue growth of 24% over the past 5 years. It pays no dividends. That means it's putting all the money that it's making back into the company in order to grow. And the increasing earnings at an accelerated rate proves that this company is reinvesting the money that it makes and is getting a higher return on that invested money each and every year. That's why the market likes this company. And you all know that in order to get into our growth portfolio, we want to see a company that has a clean surplus return on equity of 20% or higher. And this year, the company has hit 21%. And that ROE, that return on equity, is increasing. And folks, the market just loves that. Now let's look how this company has performed over the past 1 year. So that's the trailing 1 year. And it's up 80% while the market is up about 14%. So folks, this company is just totally outpacing the market. And remember, we want stocks in our portfolio that do better than the market. And over the past 5 years, this company has increased in price about 480%, while the market is up about 80%. So this company is leading the market by about 550% over the past 5 years. Folks, this is absolutely phenomenal. And the company shows no sign of slowing down. In fact, as I mentioned before, the company is increasing its earnings at an increasing rate. And looking at the numbers one more time, the clean surplus return on equity is now at 20%. So it's certainly fits into our criteria for our growth portfolio. The revenue growth is phenomenal. The stock is paying no dividend, which we love for a growth stock because that means it's putting all the money back into itself in order to grow. And the increase in earnings at an increasing rate shows that it is reinvesting all that money better than we could possibly hope for. So yes, this company is in our growth portfolio and it is doing very, very well. And I don't see any reason why it won't be in our growth portfolio for 2019. So folks, this is a good company. It's firing on all 8 cylinders. We have it in our portfolio and we will keep it there until those earnings start slowing down, and there's no sign of that. So remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. And we had a really decent week this week, so you just go out and have a great weekend, a safe weekend, and a good investing week next week, and we will see you next time. And for all you podcasters out there, we want to give you a free 30-day trial of our weekly video newsletter with market commentary, and you get all the charts and the circles and the arrows, full access to our computer program, and all the stocks in our growth portfolio. And all you have to do is go to our site and sign up, BuffettandBeyond.com, all one word. And remember, folks, Buffett is spelled with 2 F's and 2 T's, BuffettandBeyond.com. And folks, we'll see you at the beach.